All right, so chapter 12 is dedicated to understanding stocks and bonds in your book. So we will take a look at that, many different objectives to learn. So let's first of all, it starts off with a very good topic because it really is understanding risk. Okay. And we looked at your personal idea of how you view risk, right? And if you're more tolerant of risk, or you are risk averse, which means you're not tolerant. You don't like to lose money, particularly here. So, companies that we invest in really have a lot of different risks, and it thus gets transferred to us as investors. Okay. So one risk is simply that the business will fail, right? I mean, there's no guarantee that all businesses succeed. Some businesses will fail. And so there's simply a business risk that it just won't be able to survive. Certainly, businesses have financial risk. They have a series of debts that they have to manage appropriately, and that financial risk means that some companies are going to do a really good job at meeting their obligations to their creditors over time, and some companies might come into some difficulty in doing that. In general, when you and I are investing in the stock market, we have to deal with everyone's behavior. So it's not just, I know a lot of folks get frustrated when they don't see folks with masks on, even though these days, because the COVID crisis is coming back, with a lot of hospitalizations and cases, and a lot of people in society get bothered by the behavior of other people. Guess what? Same thing happens in the stock market. The behavior of investors is going to impact you. And I think particularly the behavior that we don't like the most, those of us that are more long-term oriented, are those speculators or the day traders that really sort of push wild swings in the markets on certain days. Those behaviors do affect us, sometimes for the better, sometimes for the worse, but nonetheless, it affects us. And what does it affect? It's simply volatility. It just reflects that markets are volatile. Sometimes they go up and down quite rapidly. Your goal is, in my opinion, your goal is not to react to the swings of the day. Your goal is to look at the trends, the long-term trends, and keep your eye on the long term. Um, if you are a more standard investor, and so that's important. Another thing, when we make an investment, we are foregoing this money now and hoping that it grows to something larger. So once we do cash it in the future, it can actually buy us more stuff than it can now. So that's the purchasing power risk. Inflation changes. That's the general level of prices, is what we call inflation. Monitoring the general level of prices, particularly as they go up, and most prices go up over time. And so what we're looking at is, well, when we do have an investment, is it going to be covering our purchasing power risk over the time those changes occur? But also, it certainly affects businesses because those changes affect businesses in real time, and they can, in some cases, cause trouble for certain businesses who need to purchase certain things to make their products, okay, and operate. Bondholders are very, very curious about the idea of interest rate risk, because bondholders often are making long-term investments, long-term loans. When they are lending money to a corporation, that might be a 10-year loan. If they're lending money to the government on the long term, that might be 30 years. So you're guaranteed a certain interest rate at the time you purchase it or lend it. So there's changes in interest rates over time. Sometimes interest rates go up, sometimes they go down. Well, if they're going to go up, that means the current investments can make more interest than you are. You're kind of stuck in a little bit of a lower investment product. If rates go down from where you lent your money in the market, then you're making good money on your interest because you lent at a higher rate than what investors can today. So over a long period of time, those interest rates change quite a bit. When I was sitting in your shoes, interest rates in the very early 80s were, 20%. I mean, it was really, really high. And of course, now they're down to just a few percentage points now. So there's a lot of changes in interest rates over time. Okay. Can you get your money back? Can you liquidate your investment and get money? That's liquidity risk. And so that's some of the things you have to worry about. If you don't have to worry about this as much if it's a popular name. So if you're investing or lending your money to Walmart or Disney, I don't think you're going to have any problems getting out. But it's for smaller companies where many people don't know them. Um, and trouble happens, and then you try to get out. Well, who's going to buy? Who's going to buy you out of a company that no one knows about? And of course, the reason you want to get out is things don't look good. So why should they get in? So it does cause an issue with liquidity. Can you get out when you need the cash? Um, and then, of course, we've been living with event risk, um, which is just different events that we just can't control that happen. And, whether that's a war in the Middle East or in this case, a pandemic, and it changes the economic outlook. We're all sort of subject to those. So Clark is asking, do people actually figure out liquidity? Well, I think you meant liquidity risks before investing. No, most of them don't. Most of them don't. But it is a risk they're taking, whether they know it or not. Okay, so we're looking forward. The reason we have an investment, we want to make an investment is because we want a return. So there's a few returns, right? We can get current income. So whether that's dividends from stock, interest from bonds, or if we're in real estate, we get the rents from the real estate investment. That's sort of our current income. Those are things that are happening very, really quickly. Over the long term, however, your investment could grow in value, and thus, once you decide if you want to sell and get out, you'll be selling out at a much higher price than you bought in, and so that's a capital gain. Where wealth is really accumulated quickly is this idea of, interest earning interest, which is compounding. The same thing happens with dividends earning dividends. Um, it's just a matter, it's a way of looking at compounding. And that's why it's important to start investing at an early age, because compounding multiplies dramatically over time. So for those of us that are older, we're simply not going to be getting the benefits of compounding over the next 10 or 20 years. But if you're younger, you can have compounding for 30, 40, 50 years, and that's when it really takes off. It really takes off. So that compounding rate of return is critical as wealth accumulates. Okay. And again, return in terms of interest on interest. So basically, the more you are paid in interest and that gets reinvested, your interest on interest is earning significant money. Your interest on your initial investment is this part here, but then your interest starts earning interest. And as you see over time, again, this is years, so more time passes, this starts taking over, and it can really grow exponentially. Okay, so this is the effect of compounding in essence. So that's something, the younger you are, you have that going for you if you are serious about it. But like anything else, if you're taking risks, what's the return? And so there's always what we call a trade-off between the risk and the return. And the way investors feel that if I'm taking a lot of risk, I want a lot of return. Okay, so this is what we consider what we call an expected return. It actually doesn't always work out that way, but that's what investors expect. They expect that if they're taking greater risks, they're going to get a greater return. Well, what if you're not taking any risk? Well, if you're not taking much of any risk, then there's not much of a return, right? So there's a trade-off there. Um, what we consider in finance as well, the risk-free rate of return, in which there is a guaranteed interest on your money with no risk of default. It means you can never lose your money. And that's basically what Treasury bills, the one-year Treasury bill has come to be viewed as in the financial world. It's considered the risk-free rate of return. You lend your money to the government short term for the up to a year. They guarantee to pay that back with interest. And so, what's the risk? None. There's no risk. So, does it have to be guaranteed like a bank guarantees with insurance? No. The government prints the money. And as long as they pay the bills, they pay their debts, there's no risk whatsoever. The risk here is risk-free because it's a very short period of time. Okay. And so you're not taking much risk by lending your money for 3 months or 6 months or a year. So this is what we call in finance the risk-free rate of return. And this becomes popular when, if you study finance, you'll use this into the capital asset pricing model. There's a bunch of models in finance that use a risk-free rate of return as part of its calculating of how you're doing, what your expected return should be. So, so this is important to know. No risk, but very low return. Okay. Well, what is riskier? Well, as you see here, the very bottom represents the risk scale, right? No risk is 0 here. So Treasury bills is no risk, okay? But not much of a return. This is your expected return. This is what investors expect. If they're taking more and more risks, they're expecting to get higher and higher payouts for that risk. And as you see, risk-free starts at Treasury bills. That's the money market. The money market is, in my view, very much risk-free for someone who's worked there. And then you have short-term loans, a little bit more risk. As you see, they're moving down the risk scale here. So investors are expecting a little bit more of a return. Right? They're kind of, in essence, they're tying their money up for a longer period. They're lending their money for 3 years or 5 years. They're not going to see their money back in full until that time. So they want to make sure they're getting a good return for that wait. The return is expected to be higher the longer the wait. So if you're lending your money for 10 years, you want a higher return. If you're lending your money for 30 years, you want a higher return. So, I mean, this is the idea, and it's expected. That doesn't mean it happens. It's just an expected return. So far, it has happened. History has shown that it has happened, at least in this part here. Right. For common stocks, again, it's ownership. So here we're getting into the ownership category. Okay. Here's where the lending stops and the ownership begins. Okay. And so common stocks is ownership in a corporation. Again, higher and higher risks. Obviously, a very large corporation like Disney is less risky than a very, very tiny or much smaller corporation that's just starting out. So again, even within each category, there are risks and returns based on how likely it is to survive, as an entity. So stock is ownership. It's riskier than lending in general, and so so as the risk increases, the expected return is also increases. Investors want a higher return because they're taking more risk. As you see, real estate is considered riskier, okay, than stocks, but it's an ownership market. as well. Again, the higher the risk, they want that return to be, the expected return, they want higher. As you notice here, you have options and futures and commodities and precious metals like gold and silver. And so basically here, these are all ownership markets or derivatives of ownership. And the risk is significantly higher as you go. So investors are expecting very, very high returns. The sad part is it doesn't happen as much as you keep going. The riskier and riskier means that more and more people sort of lose. It's almost like, not quite like playing the lottery, but if you don't really know what you're doing, um, it's you're almost guaranteed that you're going to be losing something. And even if you know what you're doing, you got to be pretty lucky. You know, you got to just sort of hit it at the right time. And so a lot of it's timing, a lot of it is other types of factors that risks that sort of come together to push the prices up for, oil, gas, gold, things like this. So again, the higher, these are levels of risk. If you are risk averse, you're not much you don't feel as though you're risky, you're not going to go past usually the largest of the common stocks. You're not going to go past blue chip stocks. You'll lend your money particularly to government because it's less risky, or very big corporations, but that doesn't mean you can't be an owner. You can own common stock. It's just that you're going to own the big ones. You're not going to take risks, so you're going to own the very, very big fish in the pond. For those that are a lot more risk averse, not risk averse, they actually like risks. Well, then they're going to be investing in more risky stocks. They might get involved with real estate. They might get involved with options and futures. They might get involved with commodities and precious metals, because those are very, very, very risky. So you have to have a high tolerance as an investor to invest in those areas, because there's a really good chance you're going to lose money, and you got to be okay with that. You could make money too, but the chances are a little bit better that you're going to lose money. So it's all about you. And the first um, activity or assignment I've given you in chapter 12 reflects the type of investor you are. And that really is, how do you see yourself as an investor in terms of risk? Because that's going to help guide you into certain investments that are meant for you based on what you're comfortable with. And it should help you keep out or keep away from investments that are just too risky for you. Okay. So if a broker calls you and say, hey, it's time to get into gold. Well, maybe it is, maybe it's not, but maybe that is just too risky for you because it's way over here. And you're more comfortable in this range. So you just hang up the phone, say thank you very much, but no thank you, because it's just way too big. Or you want to flip houses, or hey, let's go buy up all these abandoned homes in Poughkeepsie and fix them all up and flip them. Okay, good luck. But and sometimes it works out, but a lot of times it doesn't. You know, even if you rent to people, they got to pay the rent. What happens if they stop paying the rent? Well, in New York, you can't kick them out in the wintertime. You have to wait. In many states, it's like that. So that means you've got all the bills, to pay. You're the owner. It's your problem. It's your risk. So, all of these are significantly more risky as you keep going. So if you know how you feel about risk, you know where to stop looking in terms of investment options. What makes a good investment? Obviously, what you expect the return to be in the future. You can look at the past as an idea of how things have been going, but that doesn't, of course, mean the future is going to be the same. But that's the expectation. That sets the expectation. Again, for stock investments, you're going to be, in many cases, you'll get a dividend. Plus, you're hoping that there's going to be a greater value for your investment in the future. And so there's things that that you can compute in this regard. I'm not going to go through everything here, but I will show you a quick example of how it works here. Um, so basically, this is an illustration. And let's say that you're given a stock, you purchase a stock, and at the annual dividend is $2.15 per share. You buy the stock at 60 bucks right now. You expect in the next few years, the stock is going to be $95. That's the expected price in 3 years. Okay, so you got 3 years. So you expect to hold on to the stock for the entire 3-year period, 20, 21, 22, all 3 years. So what you can do is you can take the dividend, the 215, which is the dividend you're going to get per share. This is a per share thing. Then you're going to take what's considered sort of the average price gain over that 3-year period. So you expect a $35 gain in the stock price per share divided by the 3 years. So every year you're expecting at least a $11.67 price increase in the share over the 3-year period. And then you have to average it out, because if you simply need to understand that these are expected approximate yields. So you're using an average between where you started and where you finished to sort of get an understanding of what your return would be. So it's a $60 stock price now, plus the $95 in the future, divided by 2 to give you an idea of an average. So what you can be expecting on average is a $13.82 gain on every share that averages $77.50 over that period of time. And so it would be about an 18% gain per year for 3 years. So that's pretty good. But this is all an expected. This is an approximation. This is not reality. Things we can't really. We have expectations, but we just don't know what the market's doing. Sometimes it does better than we expect. Sometimes it does worse. There's a lot of risks in the market. But this is how investors feel about expected returns. They're hoping. And so if there is a specific requirement for a rate of return, well, the only thing that you can see as a requirement is that risk-free rate of return is going to be the lowest required return you can expect. If you're expecting anything above that, you're going to have to take more risk, and thus you're going to be approximating your rate of return. Okay. Again, the more and more risk you take, the more return is expected. So again, we've gone over common stocks before. So this is common ownership. The word stock, the word share means the same thing. Equity means the same thing. It's ownership. It's all ownership. So all these words are very much interchangeable because they all mean the same thing. Okay. So as an owner, you help to participate in when the firm is profitable. You hope that as the profits come in, they share that part of it with you in the form of a dividend. You also hope that because the firm is profitable each and every quarter, each and every year, your share of ownership increases in value over time. Okay. The risk is, of course, if things might go wrong. Debts have to get paid first if the company goes out of business before stockholders get anything. Your book actually has a look at a 10-year period of time, 2008 through 2018, for the Dow Jones Industrial Average and the NASDAQ. Okay, so the NASDAQ has smaller companies on it. They have large companies too, but they have a lot more smaller companies. And so there's a bit more risk in the NASDAQ. I told you the Dow Jones Industrial Average is simply the 30 largest companies across different industries. And it's only 30 stocks. The NASDAQ is thousands of stocks. And as you see, the NASDAQ has climbed if you started with $10,000 in 2008, the NASDAQ would have returned somewhere between $32,000 and $35,000 of return in that 10-year period. You would have more than tripled your money over that long period of time. Not to get sneezed out of the Dow here, the Dow did pretty good. It more than doubled your money as well. Did I actually do that right? No, I actually missed it. It's more than double, more than double. So again, either way, you did quite well. But again, you took more risk in the NASDAQ, and those investors were rewarded with an extra return. Okay, again, that risk return expectation happened to be true in that case. Any type of gain you make is taxed. Any type of dividend you earn is taxed. So it's not taxed. The gains are not taxed until you sell. Okay, so when you sell out, you compare what you started with in terms of your investment minus, take that away from what you just got in the sale of stock. The difference technically is a capital gain, and the capital gain is taxed. The good news for lower income folks that are in a lower tax bracket, there's no capital gains tax. But if you're in a little bit of a higher bracket, the capital gains tax is pretty damn low at 15%. Even if you're super wealthy and you're in a high tax bracket, you're paying a much lower tax on a capital gain than you are income. Dividends are income. Dividends are income. And so dividends are going to go on your tax return as income for the year. So it's subject to a regular tax rate. Okay. Dividends are can only be decided by the board of directors of every corporation. They represent the owners, and dividends are paid every quarter. So because the results are reported every quarter, some do it annually, but it's mostly quarterly. The board of directors decide what the dividend is, and it's a per share rate. So if I have one share and they say I get $1 dividend, I get $1. But if I have 100 shares, it's $1 per share, I get $100. So the dividend is a per share rate because everyone owns different amount of shares. So it's a per share rate is listed here. A lot of people like to look at the dividend yield, which is the dividend that they pay on an annual basis, so for all 4 quarters, divided by what the stock price is, and that's a dividend yield. And so stocks that have high dividend yields are either in one or two categories. They're a bargain, and you should buy them because the dividend yield is incredibly high. I mean, where could you earn 6% on your money? Nowhere, right? Where can you earn 4%? Nowhere, right? But if you buy the stock, you could. Or it could be a signal that the stock price is actually tanking, because the dividend that they use is the past 6 months. It's the past 6 months. So the past 12. So over the past 12 months, they paid this. This is the market price. Obviously, if the company's not doing well, they're not making any profit. If they're not making any profit, they can't pay a dividend. And so sometimes those high dividend yields could signal that the company isn't really a bargain, shouldn't be bought. It's actually too risky. The reason it's a high dividend yield is because the stock price is collapsing because there's no profit. If there's no profit, there's no dividend. So who gives a rat's behind about a dividend yield? So it really kind of depends on what's happening in the company. But a lot of stocks have dividend yields of 1 to 2% today. And that's much better than what you can do in most other investments that you, in terms of returns, and that's just a dividend. That's not even counting any gains on it. So there are some things out there. Even a stock that has a 0.5% return on a dividend is better than the 0.1% you're getting in your savings account at your bank. More risk, but there's a bit more return. Your book goes through a whole bunch of ways of analyzing stocks. I really don't want to get too deep into it. There's a lot of way looking at it. None of them is a surefire way of guaranteeing you're going to do okay. But there are various ways there's different data points that they look at to see whether a stock is worth purchasing or not. One of them is just looking at the book value of the shares. So that's looking at the balance sheet, taking the assets, subtracting out the liabilities and the preferred stock and seeing what's left, divide that by the number of shares, and that's the book value per share. Then you compare that to the stock price. If it's lower, it's like, oh my God, it's a great deal. I should buy it. So some companies look at that as analyze it, and some investors analyze it and say that's a good deal to do. Um, Again, it's not that it's bad, but it's not a surefire way of making money in the stock market. Some people, some investors like to look at the net profit margin, right? So net profit, net income divided by sales. The higher that is, the more profitable the company is, blah, blah, blah. Um, well, it really kind of depends. Apple has a net profit margin of 21%. Um, Walmart has a net profit margin of 3%. Um, but they're both good companies. I mean, it's one way to look at it, yes, but they're both very stable companies for the long term. Return on equity is a way of measuring the profit divided by the equity in the company. How are the shareholders doing? Profit divided by their share. And so a lot of companies think, hey, if it's highly profitable, it should be, if the return on equity is high, it's a good stock, blah, blah, blah. Yes and no. Sometimes it works out, sometimes it doesn't. Um, One of the most important things that people look at, because it's reported all the time, is what we call earnings per share. Earnings are the profits per share of ownership, per owner, right? Per share of ownership. So basically, this is reported out for a lot of companies as earnings seasons, and what they're doing is they're simply reporting out earnings per share. Um, there is something called a PE ratio in the stock market. Every company has a PE ratio, the price of the stock compared to the earnings per share of the company. And this has traditionally been a marker for stocks and that's are undervalued or overvalued because they have a lower than average PE ratio or higher than average PE ratio. It's not the be all end all, but it is something that is a big part of how investors and financial companies analyze stocks for value. Oh, I just mentioned it there, and it's right here. One thing that is somewhat important is simply how volatile is the company. So beta is what we use to measure a stock's volatility. So if the market goes down 100 points or 1%, how does your stock do? Well, a stock with a beta of 1, okay, would basically be down 1%. If the market's up 1%, the stock's also probably up 1%. So a stock that has a beta of 1 simply follows the market. Up 1, down 1, same. If a stock has a beta that's less than 1, it's much less volatile. So the stock market might be up 10%, the stock might be up 5%. Stock market might be down 10%, but the stock's only down 5%. So it's not as volatile. You don't get the highs, you don't get the lows, sort of in the middle. If a stock has a beta of higher than 1, it's more volatile than the market. So if the market's up 10%, this stock might be up 20, depending on its beta. But conversely, if the market's down 10%, it's probably down 20. So, it's one of those types of things where it's just more volatile. So beta is simply a measure of risk of that particular company, stock price, compared to the market overall. So as the market is moving up or down, how does the company stock do? Is it in line with the market? 1. Is it less volatile than the market? Less than 1. or when the market goes up and down, it really goes up and down, greater than 1. We've already reviewed the types of stocks, so this is a very quick review of this. Of course, the blue chip stocks are the large companies. They tend to be well established, they've been around for a long time. They tend to pay dividends, and you know, they're less risky. We talked about growth stocks, growth in terms of sales, operations are expanding. A lot of growth stocks don't pay any dividends, or if they do, it's a very small portion that they're sharing right now. They are relatively volatile, but they tend to do, if the growth is going well, they tend to do quite well over time. Okay. The tech sector, I don't know why they split it up this way in the book, but a lot of tech companies, and it depends on the type of tech, too, can be in the growth category as well. Some tech companies are definitely speculative because the technology is not proven or it's new. There are some tech companies that are blue chip stocks like Apple and Microsoft. So I don't know why they have this separate in your book, but that's how I would view it and interpret it. An income stock is simply a stock that pays a good dividend. Okay, it's a stable company, pays good dividends. Um, that's income stock. Speculative, you know what that means, high risk. So a speculative stock simply might be a company that has a new product or is new in the industry, and they're trying to make headway, but it's uncertain. The future is uncertain whether it'll work out or not. We've gone over cyclical. This basically follows the economic cycle, what we call the business cycle. So during growth, it's doing quite well. During recessions, it doesn't do so well. Like I said, like the auto industry, cars, people are buying them when everything looks good. People stop buying new cars when they start losing jobs and the economy's on the downturn. Um, Different than the defensive stock, which basically does quite well during an economic downturn because you still got to go eat, you still got to go shopping, you still got to do all types of things. So those are considered defensive. And then when you look at the stockholder value, if you just look at shareholder value, you have values that run in the billions of dollars. And so depending on where they're at, they're either going to be considered large cap, mid cap, or small cap. And that's basically the market value of their stock. Okay. So if you look at all the shares of stock they have, and you multiply it by their stock price right now, would it be over 10 billion? If so, it's a large cap. If it's between 2 and 10 billion, it's a mid cap. If it's a smaller company, less than 2 billion, it's a small cap. Okay. And then there are micro caps, we're in the millions. So they have all these names and terms. Someone's been drinking a lot and getting creative. So, again, mid cap, this can provide a stable return. Yes, large caps are significantly more stable. And so, those are blue chip companies overwhelmingly, large caps. Mid caps can be growing quite well. Small caps are the most risky, but they also have the most promise because at one point in time, Microsoft was small, Apple was small, Walmart was small, and so they grow over time. Of course, you can purchase foreign companies. In the United States, what you do is you either invest in a mutual fund that owns stock, or if you want to own their stock, what we have in this country, you can't buy Sony stock in Tokyo, but you can buy Sony stock in New York through what's called the American Depository Receipt, an ADR, which is simply the American Depository Receipt is basically Sony stock here. Okay, for example. So any company that's internationally based, located outside the country, but they're traded in the United States as well, what they're trading isn't the actual stock, but something based on it called an ADR. Okay. And again, because you're dealing with foreign stock, those values of those foreign companies are based on their own currency. And so as the currency goes, so it can affect the stock price. So those currency rates are important. They are important because they affect things. We've already sort of gone over this type of thing. No problem there. Okay. So in essence, don't try to time anything. Just you need to be in the market for a certain period of time. Um, so and you don't, of course, want to start really investing to a lot of money if you think the market's going down. But you can buy a little bit on the way down and more on the way up. But basically speaking, don't try to time anything. If you're going to be a long-term investor, be a long-term investor. Make steady investments, so you're not trying to time the market. And dividend reinvestment plans, which are explained in your books as well, are a good way to make sure you're having a regular, timely investment. So investors also lend money to corporations and to governments in the form of bonds. And again, what they're looking for is current income, basically, that because the interest on their investment is going to be their current income. They also want to make sure that if they're giving a corporation $1,000, they're going to get that back in the future, right? Or 10,000 or a million or whatnot. Okay. Bonds help to diversify the investments that you make. So you're not all in one category. You have a few different categories. But you can't be expecting a large return as a lender. It's different type of risk level than an owner. Okay. And you're subject to interest rate risk for sure. Here, your book has this. When you look at stocks and bonds for this 20-year period of time, stocks represented by the S&P return, this red line, which is actually ended up here. Bonds have done exceptionally well. This is actually the bond line way up here. Because over this period of time, the reason bonds outperformed stocks in this period of time is because interest rates went from nearly 9-10% down to close to zero. And as interest rates go down, the value of bonds go up. Because if you already locked in to a bond at 9% way back when, and currently you can only get 2%, that 9% bond is very valuable. And so the value of the bond actually goes up over time, because who wouldn't want to get 9% in an error that only pays 2%? So your bond becomes very valuable property, and that means the price of it goes up. So bonds, you can actually get capital gains from bonds as well. It's not just interest. And that's what we've seen over the last actually 30 years. We've seen bond prices skyrocket over time, become more valuable because interest rates keep going down. That doesn't happen when interest rates go up. When interest rates go up, bond prices go down. The value of bonds go down because the most current interest rate needs to be compared to what the investments are currently. And so if you can lend your money at a higher rate, you're going to do that. So bond prices actually fluctuate over time. They are debt, so they're liabilities to whoever is issued. They're receivable to you as a bondholder. Okay. Bonds pay interest every 6 months, unlike dividends, which are paid every 3 months. Bonds pay interest every 6 months. They used to be, interest used to be called a coupon, but that's because many years ago, when you received the bond, literally there were little tiny pieces of paper, little coupons that were attached to them. And you'd rip off one little tiny paper and you'd bring it to the company and say, here's my coupon, give me my interest. Now it's just referred to as an interest rate, a coupon. It's all done electronically. You don't have to worry about all that stuff. Again, every bond is $1,000. When do you get that $1,000 back? Whenever the maturity date is, that is the due date. That's when you get that back. Bonds that are issued, they're issued at $1,000 per bond. And so if you pay $1,000 for a $1,000 bond, you're basically paying what we call a par value for your bond. Okay. It's 100% of the value. However, sometimes, as I told you, bond prices go up and down. And just because I bought a bond 5 years ago and it's not going to mature for another 5 years, doesn't mean I can't sell it today. I can sell it today. What's the price that I'm going to sell at today is going to be different when I bought it, and it might be different in the future. So if the bond price is actually lower than what I paid for it, lower than 100% of the value, then it's a discount. If it's higher than the value, over 100% of the value, it's a premium. Okay. And bonds can be actually categorized as more secure, which is they're backed by assets, or they could be unsecured bonds, which are simply backed by the credit history of the company, the credit rating of the company. To help investors feel good about lending money to companies, bonds have set up a number of characteristics to make investors feel comfortable. One of them is called a sinking fund. And a sinking fund is a promise as part, because a bond is a contract. Okay. So part of this contract says, look, as a company, we are going to set aside a certain amount of money each and every year to pay the bond back when it's due. And so that becomes a characteristic of saying, well, it's less risky for me because the company's going to be putting aside money every year to pay us back. It's not like they're not going to do that, and then 10 years later, they don't have the money to pay us all back. So a sinking fund helps investors feel if I lend the money, they'll have the money to pay back. One thing that actually benefits the company itself is something called a call feature. To call is simply an option to pay it back early. So again, when you're a lender in the bond market, you're expecting to lend your money for 10 years or 20 years. If the bond has a call feature, you're allowing the company to pay you back sooner than that. So they can pay a 10-year bond in less than 10 years. They can pay a 20-year bond in less than 20 years. Okay. It's sort of, one of those types of things that help the lender. Okay. And then your book explains that a free call is basically any time they can pay the loan back. A deferred call is a period of time that goes by, and then they can pay the loan back early to investors. And then there are bonds that can't be paid back early, non-callable bonds. So that's your book just sort of explains all of that in general. There are 4 major segments of the bond market for investors. The US government has treasury and agency bonds for them. State and local governments are in the municipal bond market, and corporations are in the corporate bond market. So the market has 4 major segments for investors. US government is the first 2, state governments and local governments are municipal, and corporate is the last. So Treasury is a US government based, and Treasury notes are 2 to 10 years in length in terms of loans to the government. A Treasury bond is up to 30 years. 20 to 30 years, although 30 years is the most common. Again, all of these bonds are at $1,000 each, and Treasury bonds are not callable, which make them attractive investments because it's going to be the loan for that whole period of time, and you're going to be guaranteed interest for that whole period of time. I think the government doesn't have the money to pay it back anyway, so they're going to print more, basically. So this is an important feature there. An agency bond is, again, it's a loan to the U.S. government, but to its agency, to one of the agencies that have that need money. So, like, federal home loan program, government home loan program, um, need need money for mortgages. It's a pretty big agency here. Municipal bonds are about local or state governments, or agencies within local or state governments, like SUNY or a turnpike authority, for example. Again, when a municipal bond, when you lend money to a municipality, the interest is free from tax, totally exempt. There's no tax on municipal bonds if you live in that state. So if you buy anything in New York, a municipal bond from any part of New York, whatever interest is paid to you on that bond is not taxable. Not taxable. However, if you sell the bond at a profit, a capital gain, that the capital gain is taxable. Municipal bonds are generally safe because almost all of them are insured. Um, but they're not totally risk-free because, unlike the federal government, which can simply print money, the state government cannot do that. Okay, and so that's a big thing. Um, for example, the state of New York issued a whole bunch of revenue bonds to build the bridge, the new bridge at what was Tappan Zee Bridge, replacement is the Mario Como Bridge now. Those bonds, because they needed, $1 billion or so to build a bridge. So boom, where does the state get that type of money to? Well, they issue bonds. So they promised to pay the bondholders back with the tolls from the portion of the tolls from the bridge. So that's a revenue bond. Others are simply general obligation bonds, which means that, look, we need money in general. We promise to pay you back because we've always paid back our debts. And so that's a general obligation bond. Okay. Corporate bonds are, because any corporation can go ahead and literally go to the markets to raise money this way. So again, they tend to be grouped by various segments. You have industrials, utilities, rail and transportation, and financial issuers. Most bonds are roughly about 10 years in terms of maturity. The interest that you receive is taxable, so any type of interest. Some bonds have relatively high yields, okay, which means that they're paying a very high interest rate. Okay. And then there are some bonds that are sold at a discount. So instead of paying $1,000 for a bond, you'll pay $700 for the bond, and then in 10 years they'll pay you $1,000. So those are considered zero coupon bonds. They don't pay any interest, but they accrue to the maturity value over time. So that's how they work. Bonds have various features as well. They can be converted to, a corporation has the common stock, so you can convert your bond, which is a loan, to ownership in common stock. There's a specific conversion ratio, which means your $1,000 buys a certain number of shares of the stock. So you have to go ahead and figure out whether it's worth doing that or not, or keeping the bond. But it's totally, actually, that's totally up to you as the investor. But like you and I have credit scores, corporations have bond ratings or credit ratings. Okay. And they basically are broken into two parts. They're what they call investment grade bonds and risky or junk bonds. And here is, again, there's a couple of rating agencies. Moody's does financial analysis. Standard and Poor's does financial analysis, and they make calls on their bonds. And as you see, there's a huge difference between what we consider investment grade bonds and what's considered junk. And riskier bonds, right? So again, a triple A is basically virtually little risk. Okay. Double A, or AAA in a different way here, for Moody's, you're basically, extremely high grade, very safe, no worries here. A single A bond is still quite good, still a high rating. Um, but that's so sometimes rate, and of course municipalities also have bond ratings. So our Dutchess County is a double A bond rating, because Dutchess County has a segment of, is a municipal government in and of itself and borrows money in the bond market, and it's considered a high grade investment bond as well. You can get as low as triple B for S&P or BAA for Moody's, which means that there's a little bit more risk, but in general, it's the company that's issuing it, or the agency that's issuing it, has been pretty good. Okay, but there may be some economic conditions that might affect its ability to pay. So it's not an A or triple A bond; it's B or triple B. Anything below that, BB and all the way down to C, basically these are poor quality. These are companies that have um, financial challenges, to say the least, and they might have a problem paying back their money. What's different here is a D. That means the company is in default, and that means that they've stopped paying interest on the bonds. Okay, so again, the closer you are here, it's interesting. So bonds are priced at a percentage of their par value, $1,000, because one bond is $1,000 loan. So bond prices reflect that percentage of $1,000. So a bond that's priced at 95 is basically means that it's being sold at 95% of $1,000 value, which is 950. So this bond would be basically, this is selling at a discount because it's less than 100% of the value of the original loan. Now you pay 950 for the bond. If you buy it that day, they pay you back the $1,000 when you're owed. Okay, when it matures. Okay, sometimes you might buy a bond that has just been brand spanking new, and so you're going to get a clean price, $1,000, what have you. Some bonds that are new don't sell for $1,000. They might sell for a little bit less, a little bit more, because interest rates can change dramatically within a day, and so they can. But a clean price is basically you're just doing the loan. Sometimes you're buying a bond from someone else, and so you not just have to pay the price of the bond, you're getting interest on that bond, because the interest is going to be transferred to you as a new owner. So you're going to pay the owner back interest. The old owner is going to get accrued interest. So it's considered a dirty price. So again, a bond is sold at a discount when it's less than 100% of the $1,000 price. Sold at a premium when it's more. So what does this mean? Is that if you buy a bond at a premium, which is say $1,050, you're going to get interest on that for the period of time that you bought it, but they're only going to pay you back $1,000 when the loan comes due. The fact that you bought it at a premium probably means that the bond is paying a higher interest rate, and the owner of the bond sold it to you at a higher price because it's worth more. So that's usually how it works with the difference between premiums and discounts. Okay. So again, here you have a bond that's currently paying 4%. That's the interest rate on the bond, but as time goes on, the market rate is 2%. So the best investors can do is a 2% return on a loan. You have a 4% bond. That bond is valuable. You go ahead and sell that bond to another investor, it's going to sell at a premium, more than 100% of the value. But you have a 4% bond and interest rates take off to 6%. So investors currently can get 6% on their money. You're stuck in an investment that's for 4%. Who the hell is going to want to buy your bond? not for the full price. So you sell it at a discount, less than $1,000, right? So it equals the current interest rates that are being paid. And that's basically how bonds work. So the yield on a bond is quite easy to figure out. It's whatever the interest payment is versus the market price of the bond. That's basically it. And there's not much to calculate there, and I'm not going to get into that area here with you, but the yields are pretty simple. How's the overview there? A little bit more detail than the first time, but again, important to sort of understand there's differences there. Questions?